will do is I will extend the closing date for quiz 3 to make sure that you all have sufficient time after we cover the chapter in class to take the quiz. So so that's a promise from me. I will make sure that the due date for or the closing date for quiz 3 is extended. I will either I'll do it or I'll have somebody online do it correctly. So that part is done. But 6 and 9 is something that we will positively cover today, and then we will do some examples to kind of reinforce the concept. Yes, sir.
Will the test cover any other chapter besides 6 and 9?
Nothing. Only 6 and 9. That's it. There are only 2 chapters on the test. The test will cover only 6 and 9.
Is it going to be on quantitative or is it going to be
It will be mostly quantitative.
Thank you, sir.
Mostly. It will be a very numbers-driven test. Okay. And by the way, the test is completely open book, open notes. Yeah, everything. You don't have to memorize anything. You can bring anything you want. You can bring your book. You can bring your notes. You can bring
Can we work together?
No. Okay, I'll tell you what you cannot do. That's the okay. So what you can do is bring a book, bring your notes. Bring notes of encouragement to yourself, whatever, everything that you want, you can have it in front of you. What you cannot do are a few things. Number 1, no use of cell phones during the test. That's number 1. Number 2, no use of a computer during the test. You cannot use your computer. So if you want to bring any file or anything that you have stored on the computer, print it out and bring it. I don't care. But there will be no use of electronic equipment during the test. It's a paper-based test. You will do it on paper right here in class. But any bit of paper that you bring, everything you want, you can use a calculator. That's not a problem. But
on the cell phone?
I'm sorry?
Calculator on the cell phone?
No. See, this is I know. This question comes up all the time. It's a fair question. I don't blame you at all for raising this. There are people, who have forgotten calculators in their lifetime, and so now they use the cell phone as a calculator. My son does it, my daughter does it, everybody does it. Well, the point is, I don't do it. That's a different matter. But again, that's a fair question. I would say no, only because I need to be fair to the whole class. So once I open it up, then the question is, then why not somebody else? So then the whole thing about locking the cell phone makes no sense at all. And I will tell you why. I mean, you guys are unfortunately bearing the brunt of my cell phone policy. Yeah. You didn't make this happen. This happened because in a previous, 4 or 5 years ago, and it had nothing to do with the healthcare MBA program. The program was not even there at the time. It's a totally different MBA class. I did not have the cell phone policy. And what happened was, after a test was completed, 2 students came to me and they basically said, students were exchanging the answers to the multiple choice questions through text messages on cell phones. There was considerable use of cell phone during the class. I didn't really care because once I have a policy, I stick with it. I don't generally do anything else. I don't mess with it. If I announce something, then I stick with that. But 2 students, and even the strange thing is, even I didn't notice it because I'm not looking for those things. In a graduate class, you don't go around looking for people to cheat. It doesn't work that way. But I had missed it, but 2 students came to me and they complained that it was unfair because there were at least half the class, and this is not a small group, half the class were exchanging answers to the multiple choice questions using their cell phones. And at that point I decided I'm not going to permit cell phones in the class. So I know you have a very legitimate concern about the calculator. Find a calculator and bring it, please. But then please don't use the cell phone during the test. Okay? So that's my rule. So otherwise, all material is allowed. Any printed material you want to bring is fine. No problem.
How long is the exam?
The exam should be a maximum of 1 hour. I might give you a 10-minute extension, but beyond that, you will start losing credit. If you turn in late, after the 10-minute extension maximum, then I will take away points for turning in late.
1 hour, how many questions?
1 hour, yeah, I'm getting to that. I'll let you know. By the end of the day, I'll let you know. Yeah.
The exam is at the last day of class, or?
I'm sorry?
What is
No, next class.
Next, this coming. next meeting that we have, we will have the test. In exactly 2 weeks. The syllabus says that. I mean, you can see that in the syllabus. The syllabus lists 28th as the day for the test. Oh, by the way, and also the last thing is on the 28th, folks, on the 28th, at the request of Professor Weedong, we have exchanged. He had some commitments in the, that he could not, he had some commitments in the morning. So what I have said was I will exchange with him. So on the 28th, we are meeting in the morning. So the test will be in the morning. So we'll start the class at 8:30. So I'll start the test at 8:45 for people to come in. So from 8:45 to 9:45, maximum say 9:55 or so. Yes.
Is it like open-ended questions or multiple choice?
No, never open-ended in this place. There will be multiple choice, and there will be, workout problems. There will be probably about 8 or so multiple choice questions and 2 workout problems. So total of 10 questions. But the multiple choice, it's either you got it or you don't. But in the 2 workout problems, you will get partial credit.
So multiple choice questions like the quiz kind of questions?
Yeah,
or?
yeah, like the quiz type kind of questions, correct. That is correct.
And it'll be on these 3 chapters.
Only 2 chapters. Only 2. Only 6 and 9. Read. Look at the syllabus. Please, always, I say this, look at the syllabus. And the syllabus lists exactly what chapters are covered in what. And so, if there is a contradiction in the syllabus, I will need to know so that I'll fix it. But this is completely syllabus driven. Okay. So I've told you in advance, and that's what we will do. All right, so let's begin with, okay, by the way, let me start. Does anybody have any questions from the previous classes? From the previous meetings, anything from the boot camp, any remaining lingering issue of, any conceptual matter that you want me to explain, go over? I know there was a question about unearned revenue. Somebody asked me privately early on. I just want to reiterate, unearned revenues are liabilities. And they are liabilities because why? You have received money in advance of performing the service or delivering the product. So it is revenue, but it is going to be revenue later on when you do your part to earn that. That's why it is unearned. The moment revenue is unearned, it becomes a liability. It cannot be part of owner's equity as revenue. Okay? So unearned revenue is a liability. It's like customer advances. Some customer comes and pays you advance, and you say, okay, I'll do the job, but until you do the job, you cannot call it revenue.
That's the airline example, right?
I'm sorry?
The airline example.
The airline example. That'll be a classic example. Home Depot example, all the time. You go do a special order, they're going to take your money in advance and do this. And there was a time when you had to, even car sales had unearned revenue. There were people, you have a new model coming out, and then everybody wants it. The dealer doesn't have inventory. And he says, okay, you got to put money down. I'll reserve the car for you. So when the dealer takes your money down, that is unearned revenue to the dealer. Okay. Yes.
All right, I have a question. It's concerning like calculating a current ratio. Right? When you look at the equation, it seems simple, like current assets divided by current liabilities. But
Yes.
when you have it set up in the documents, like in the book, and you have things like total current, average current, which one do you use?
Okay, the term total current assets is the same thing as current assets. When they say total current assets, all they're doing is they're taking individual items of current assets and adding it up. So that is what goes into the ratio.
No matter how many ways they put it.
Doesn't matter. The moment they say total current assets, those are your current assets.
Oh, because I saw current,
Yeah.
average, and
Average is different. Total current assets, see, remember, current assets is what? Is from the balance sheet. That is at a point in time. Balance sheet is always at a point in time. It is as of December 31st. It is as of June 30th, like that. It is at a point in time. Average current assets is something else. Average current assets has to do with how it has been on an average over a period of time. So the way we compute the average current asset is that we take the beginning of the period, take the total, at the end of the period take the total, and we take an arithmetic mean of the two. That becomes your average. So we kind of assume that if you take an average of the beginning and the ending, that's where it has been throughout the year. It's an assumption, it is not true, obviously. So average current assets is that you pick it at 2 points in time, take an average of the two, that's an average current assets. But if you, in the current ratio, you don't use average current assets, you use current assets, which is at a point in time. So the current ratio is as of December 31st, 2013. As of December 31st, 2014. Right? Average current assets for 2014 would be, okay, so I'll put it visually for you. So supposing you have a balance sheet as of, okay, 12/31/13, and let's say 12/31/14, all right? So you have, let's say, cash and receivables. Let's say that there are only two current assets. So cash and accounts receivables, okay? Let's say $100 in cash, 500 in receivables, and here it is 150 in cash and 600 in receivables. Okay? So let us say current liabilities total are, let's say, 300 and 250. I'm just pulling some numbers here to illustrate your point. So now, to compute the current ratio, you got to do it at 2 points. You cannot do an average current ratio. You have to do a current ratio as of 12/31/13. For that, what you do is you take the sum of these two, $600 in the numerator. So it will be equal to $600 divided by the denominator of $300, the total current liabilities, which is equal to 2. The current ratio is just a number. $600 divided by $300 is just 2. So you say that as of 12/31/13, the current assets were 2 times the current liabilities. We can do the same thing as of 12/31/14. We can recompute the current ratio based on these numbers. So we got $750 in current assets, and we have $250 in current liabilities. So that makes it 3.
And it's always 3-to-1 or 2-to-1, right?
You can say 3-to-1, 2-to-1, or you can just say 2-3. That's fine.
Okay.
Because 2-to-1 is the same thing as 2.
Understood.
Mathematically, 2-to-1 is 2, 3-to-1 is 3. But again, it's up to you. It's just a style.
In the book it says it always has the 2-1 or 3-1.
That's fine.
I was wondering.
So then if that, so that,
Because they want to show assets, liabilities like that. So that's why, which is
so
fine.
the total
Either
current
you report
ratio-
it this way or 2-to-1, 3-to-1, I will take both. Doesn't matter.
So the total current ratio would be 2.5?
No, there is nothing called a total current
Oh,
ratio. There is a current ratio. And the current ratio is computed as of the balance sheet date. Okay? Is that okay now, so far?
Yeah.
Now, if you ask the question, what is my average current assets during 2014, what has been my average, then what you do is you take the 600 and you take the 750 and take a mean of the two. So average current assets during 2014 would be equal to 600 plus 750 divided by 2. Okay, which is equal to $675. And the average current liabilities during the year would be 300 and 250 divided by 2. Average current liabilities during 2014 would be equal to 300 plus 250 divided by 2, which is equal to $225. Now, you don't do a current ratio based on these two. You don't. You don't do a current ratio based on average current assets and average current liabilities. But the average current asset is used in a context. In a different ratio or in a different context it is used.
275.
So when you use the term average current assets, okay, this is what you're doing. You're taking an average by taking the midpoint of the beginning and the end of a period and taking, okay, we are assuming that during the year it stayed at an average of around 675. Right?
275.
Yeah, it's 275, 225.
What? Oh, this one?
Yeah.
Oh, what? Of course it's 275. Thank you. Thank you very much. Thank you. Appreciate it. 275. Sorry about that. So the average current liabilities are 275 and the average current assets are 675. But for the current ratio, you don't use these average numbers. You use exactly the numbers at that point. Okay? So on your project report, I don't want to see a mistake on this. Now that we have covered it, we have covered it. Okay. Alright, so So I'm assuming that all these mean that these people are here, but they're not in class.
Now you-
So, so we are going to begin with inventories. Now, I don't know if you notice that now what we are doing is, see, in the boot camp and in the first class, what we ended up doing was looking at a set of transactions, moving from a set of transactions through the whole cycle of the accounting process, and then coming up with the financial statements at the end of the transactions. So like an overall picture. So we have a picture of how accounting is done in the organization, how transactions get recorded, and how from the records of the transaction we move on to say getting the financial statements. So that is done. Now we are starting the process of going into individual sections of the financial statement and looking at accounting rules that are specific to that section. So for example, we will start today with inventory, then move on to depreciation. These are two key things that go on in certain important sections of the financial statements. So we will begin with inventory. What is inventory? Inventory is whatever you have with the objective of being sold. That's what is generally called inventory. Or if you're a manufacturing firm, it is whatever you have with the objective of consuming it to generate a sale. So inventory is always related to sales. Okay? You don't call a machine as inventory. Even though you are using the machine to generate a sale, a machine itself is not consumed in the process of generating a sale. Inventory always is consumed. Either it is sold as it is, in which case it is consumed 100%, or it is used in a manufacturing process to generate a finished goods, if you will, and which will be ultimately sold to a customer. So the difference between an inventory and a fixed asset like buildings and land and let us say equipment, the difference is that the inventory in the short run will be consumed in order for you to earn a revenue. So inventory, the consumption of inventory is matched against the revenues that were earned. Okay, so that's the key idea about inventory. Now, we already know that there is this balance sheet equation, and the balance sheet equation says that assets equals liabilities plus owner's equity. Okay, assets equals liabilities plus owner's equity. We already know that. Now I'm going to introduce a new equation which is specific to inventory. And the new equation specific for inventory says beginning inventory. It's actually pretty intuitive, but I'll still write it out anyway. Beginning inventory, and I'm just going to call it BI, plus purchases, I'm going to call it P, minus ending inventory, I'm just going to call it EI, equals cost of goods sold. Or COGS. Because I'm going to be repeatedly using the term, so I'm going to abbreviate it. So the idea is that beginning inventory is what you start at the beginning of the period. So let us say, we had the lawnmower example. The company starts its operations. So at the beginning of the operations, it has nothing, right? So basically zero. Then it buys what? 5 lawnmowers. Okay, if it buys 5 lawnmowers, so that is $500. That's your total purchases. So they paid $100 each to buy 5 lawnmowers. So that's a total of $500. Then at the end of the first year, they have already sold four lawnmowers. Correct? So they have 1 lawnmower left. So therefore, what do we say? Okay, the ending inventory is $100. which is the cost of that one lawnmower that they still have not sold. So that tells you 0 plus 500 minus 100 equals 400, which becomes the cost of goods sold during that period. So in the first year, they sold four lawnmowers, and the cost of the items that were sold during that period is $400, which will be matched against the revenues for the period. We saw $600 in revenue, so we came up with the $200 profits for the first year, in that example that I started the class with during boot camp. So therefore, the idea is that the cost of goods sold is arrived at by looking at beginning inventory plus purchases minus ending inventory. Now, yes.
So the purchases, the numerical value I have to put is what the company bought the item for. Not
What they
what
bought it
they
for.
sold it for.
No, that becomes a selling price. That becomes revenue.
Okay.
They bought the item for 100, they sold it for 150. So 150 is your revenue, 100 is your cost of goods sold, so you made a profit of $50. So now I'm going to rewrite this equation. Yes? Question? No? Okay, I'm going to rewrite this equation in a different way. So I'm going to say that BI plus P, and I'm going to move the EI to the other side, equals cost of goods sold plus EI. Okay? Keep this relationship in mind, because it's basically rewriting this equation. The same equation rewritten becomes BI plus P equals COGS plus EI, and this will come of use during our session today. Okay, the other way of writing this equation. All right, so now let's begin with some examples that I will take you through, where we can think about this mentally to kind of motivate the whole discussion here. Since my family is in the process of buying a car, so I'll use the car example.
Also mine.
Yeah, we've been doing this. This is not funny. We've been buying a car for almost now 1 week. That's ridiculous. I mean, it should not happen this way. But that's what we're going through.
Why is it taking that long?
Why is it taking that long? Because it's us. We are the ones buying it, so that's why it's taking that long.
He teaches
It's got nothing to do with the car. It's got nothing to do with the dealership. It's got everything to do with us. So we are really discussing. No, we know the car. We know what we want. We have kind of arrived at it, but we just cannot deal with it.
You're gonna get another van?
Sorry?
You're gonna get another van or no?
No, we're going to get a wagon. Oh, by the way, no, I don't have time for that today. Let's go somewhere else. All right, so now, take for example, let's say you are a car dealership. Okay, you're a car dealership, and let us say you are a Toyota dealership. So you buy you're selling Toyota vehicles. So the vehicles come in and the customers buy the vehicles. Now, let's say you sell a vehicle to a customer. Okay, and you bought the vehicles from the manufacturer, from Toyota, at different prices. The vehicles come with different options, maybe at different prices, maybe just over a period of time. So the prices have changed, so you bought it at different prices. When a customer comes and buys a vehicle from you, you are able to determine exactly how much profits you made on that one vehicle that you sold. Why? Because you have an invoice price for that vehicle. The invoice price sets out exactly what is the money that you will either pay Toyota or you will pay Toyota for that vehicle. And you know exactly how much you're selling it for from the customer, so you're able to determine what the profits are for that vehicle for you. That's what we call as specific identification. In a specific identification system, every time you have revenue, the cost of goods sold is specifically identified against them. So it is like, for example, tagging the item with a price at which you bought that item. So the moment it goes to the checkout counter, somebody can look at the tag or somebody can scan the tag and immediately determine how much profits you made on that item. Because the customer is paying you or will pay you, and you know exactly how much it cost you. Now imagine that you are, let us say, so let's say that you are a grocery store. Now, you're getting the same item every month, probably at different prices. Okay, and you're putting them all in the shelf. The customer comes, takes it out. Now, you have to invest in a fairly sophisticated inventory tracking system to be able to tag every package that a customer picks up. So now, today, if I go in and let us say that I pick up, a gallon of milk, a milk carton from, let's say, Costco. Now, Costco may have bought that milk cartons, over a period of time at multiple prices. So when I pick up that milk carton and walk out, Costco knows exactly how much I'm paying for that carton. But they are going to have a hard time finding out how much they actually paid for that carton from whoever supplied the item to them. Because from the same supplier, they might have bought milk cartons at multiple prices during a period, and they may all be sitting in the shelf at multiple prices. So therefore, now we have a problem. Now we have to make certain assumptions to say, okay, the carton that I'm walking out with, how much did that carton cost Costco in order for Costco to determine, how much profits they made on that one carton that I put up. Okay. Now, given that, so that is the reason why we need all the inventory assumptions. So there are broadly 3 assumptions that we make. One is called the FIFO. So I'll erase this.
So these are called inventory assumptions.
I'm sorry?
This will be called inventory assumptions.
These are called cost flow assumptions.
Cost flows.
Cost flow assumptions, but they all pertain to inventory. So if we are going to look at 3 broad, type of assumptions with respect to cost flow. So which is what is called as first in,
First out.
yes, first in, first out. Our typical queuing system. Okay, you get into the queue first, you get served first. Okay, so first in, first out. Typical queuing system. The second, last in, first out. Okay, last in, first out. Now here we are talking about VIP. Okay, somebody who got into the system last, they get out first. Right? Just kidding. So the idea is that last in, first out means the newest items in inventory got sold first. Again, it's an assumption. This is very important for you to understand. This has nothing to do with the way the goods are physically moving on the shelves. This is strictly an accounting assumption, meaning that accountants can make the assumption of first in, first out, last in, first out, or an average costing assumption, no matter how the items actually move in the shelves. Okay? So one way or the other, so you're going to make an assumption, and it does not matter how the item actually moved in the system. So the second assumption we'll talk about is last in, first out, and the third assumption we will talk about is what we call as weighted average. Weighted average, or sometimes it's also called average costing. Average cost assumption. Okay, so they mean the same thing. Basically, you either use a weighted average assumption or average cost assumption. So I'm going to illustrate that through a set of examples. That we will go over, and in your Blackboard system, you will see a file called inventories. That's the file that I'm going to be using now. There's a file called inventories for this week. So we will use that file to go over this section. So let's assume the following. So here in this inventory example, we are beginning with inventory at the beginning of the period, which is 1st of January. You have 200 units in inventory at an average cost of $1. So you have totally $200 of inventory to begin the period with. Then during the period, you made purchases. You made purchases on the 1st of March of 300 units at $1.20 each, or $360. Then on the 1st of November, you made 800 units purchase at $1.50, which is $1,200. So how much do you have available for sale? So that's where this equation comes handy. You can see the left-hand side of the equation, which is beginning inventory plus purchases. That's what you have available to sell. This is not a manufacturer. So this is like a Kmart or a Walmart. Okay? Or maybe you are just a store which sells exactly one item in that store, and you are getting it at multiple prices, and you are selling them, okay, during the period. So now on the left-hand side of the equation, that's what you have available for sale, meaning what you already had at the beginning of the period, plus whatever you purchased during the period, together becomes what is available for sale during the period. Now let's assume that you made 2 sales. On the 1st of December, you sold 100 units. It doesn't matter at what price you sold them, because we are not trying to compute profits, we are only trying to compute the cost of goods sold and the inventory at the end of the period. So that's what we are trying to compute. So we don't care about at what price those 100 units are sold, but we do care about what is the cost of those 100 units to you, okay? Because you've been buying it at different prices. So then let us say that on the 1st of December, you sold another 1,100 units. Okay? So there were 2 sales during this period, during this year, 100 units on 1st of December, 1st of October, and 1,100 units on the 1st of December. Okay? Now our objective is to determine how much is cost of goods sold for the period, meaning that what is the cost of those 1,200 units that you sold, and what is the value, the dollar value of inventory at the end of the period, because when you prepare your financial statements on the income statement, you have to show how much was cost of goods sold, and on the balance sheet, you have to report how much inventory you have at the end of the period. So therefore, you know what the left-hand side is. The beginning inventory, you know, $200. The purchases, you know. There is no need for any assumption here, because you know what the purchases are. 300 times 1.2 plus 800 times 1.5. We already know that. Okay? So you know beginning inventory, you know purchases, but you do not know the 2 items on the right-hand side. At this point, we don't know. So therefore, what we need is that we need an assumption which will help us determine what the cost of goods sold is, and we need an assumption to determine what the cost of goods sold is and what the ending inventory is at the end of the period. So the first assumption we are going to make is what we call as the weighted average, or the average cost assumption. In the average cost assumption, what we do is that we pool the beginning inventory and purchases together as the total amount that is available for sale divided by the quantity to get the average cost of all the items that we had available to sell. Right? So what we do is that we take the beginning inventory of $200 plus take the purchases $360 and $1,200, giving you a total cost of $1,760 that were available for sale. And that cost is distributed equally among all the units that contributed to that cost. Well, we had 200 in beginning plus 300 first purchase plus another 800 the second purchase. So we had a total of 1,300 units that contributed to the 1,760. So we simply pool it all together and get one average cost number. And the average cost number turns out to be 1,760 divided by 1,300, or approximately $1.35 per unit. Okay? So it is not the arithmetic average of the 1, 1.2, and 1.5. It is actually a weighted average computed based on total cost divided by total quantity. So if you bought a lot of items at a certain price, that item would have a high weight in the computation. So that's why we use the term weighted average. Okay? So we just don't take 1 plus 1.2 plus 1.5 divided by 3. So we don't take the average of the 3 prices. We take the total cost divided by total quantity to get a weighted average cost. So far so good? Any questions?
Yes, sir. Whoa.
Yes, sir.
What does the weighted average represent again?
It represents kind of an approximate cost per unit of all the items that you had available to sell that year.
Per unit.
Per unit, cost per unit. Because we need that to assign it to the units that were sold and the units that are still with you.
And it doesn't matter if it's inventory or purchased or if it's been sold. No?
The ones that are
This
less.
is the 1.35 that you got is the weighted average cost of your beginning inventory plus purchases. It's specific.
Yeah, the sold is
No,
not included
but-
in there.
In calculating, the amount of, unit that we have, we took into account everything. The inventory, the purchases, and, the item, the sold items.
That's coming later. Right now, the only question we're asking is, what is the average cost of all the items that we had available to sell?
So you don't worry about the sold items, you just.
Not
worry
yet.
about Inventory and purchase.
Not yet. To compute the average cost per unit, we don't yet worry about the sold. We just simply say, okay, fine, think about this, I bought, let's say, 2 units at $1, 3 units at 1.2, and let's say 5 units at 1.5. I don't care yet about how much I sold. All I'm saying is that what is my average cost of everything? So 2 times 1 plus 3 times 1.2 plus 5 times 1.5, the whole thing divided by 2 plus 3 plus 5.
Sorry, baby.
So I get an average cost right there. Then I'm going to apply that to the units that I sold and the units that I still have. That
Okay.
comes to the second step.
Got it. So that's the 800, 300, and 200.
Yeah.
Which is, okay.
Question?
Yeah,
I'm so sorry.
no, actually, I was
No,
gonna.
why do you have to do this?
Well, we're trying to figure out, like, the available for sale.
He really means it when he says he's sorry, right?
Yes.
Well,
Just kidding.
is the available for sale number given, or is it calculated from something? Like that 1300?
No, there's nothing, it's all given.
Yeah,
It's
it's
given from 200, 300, 800.
So available for sale is in units.
No, available for sale is in units and in cost, both.
That you bought.
There are 1,300 units available for sale at a total cost to you of 1,760. You paid 1,760 to get this 1,300 into your system. So the average cost for you is the 1,760 divided by 1,300.
Total is the cost. So you have a total of 1,300 units.
That you could have sold.
The total cost of $17.
So on an average, you have paid $1.35 per unit. On an average.
The 1/1 signifies January 1st.
Yeah.
3/1, so those are the dates. So
Yeah.
on January 1st, I had inventory 200 units. Then on March 1st, I purchased an additional 300 units, and now I have 500. Then in November, I purchased 800 for a total of 1,300. And then I put all those, I assigned all the prices to each unit, and then I get the aggregated cost because each time it has a different price.
Yes, Professor. Quick
Hang on,
question.
just a minute.
Why,
Yes.
why are we taking in consideration for purchases the inventory that we already had?
Because that was also available to sell.
It's also available to sell.
So it's cost of goods available for sale. So you could have sold those 200 too this period because you started the period with the 200. Even if you didn't make a single purchase, you could have still made a sale out of the 200 units.
I see.
So therefore, that's why it's included.
Could you,
Yes?
could you, I guess from my own notes, trying to simplify the weighted average as a formula, you could just total dollar amount divided by the total number of units.
Oh, you can just say, yeah, you want to, that's it, you just said it. You said it. Just write it down that way. That's fine.
Inventory plus purchases divided by.
Total dollar amount of beginning inventory plus purchases divided by the total quantity of beginning inventory plus purchases. Yeah?
I have another question.
So I was working off your answer already. Yes.
So what's like the end goal for getting all this information? Like what's
We are not even there.
No, but I mean, it just puts it
We're
in
not even there.
perspective for me.
No, you want it in perspective? The end goal is to determine how much is cost of goods sold and how much is ending inventory.
Okay.
There are two things we don't know in the right hand side. So our idea is to determine how much is each of those two things. That's the end goal. Okay. So now we have an average cost of 1.35, so it's very simple. Now we simply apply that 1.35 average cost to the ending inventory plus and the cost of goods sold. Now we know quantity wise, we know exactly how much ending inventory we have because we had 200 beginning plus 300 plus 800, that's the total available, minus we sold the 100 and the 1100, so subtract the 100 and the 1100, you are left with 100 units. So at the end of the period, you are left with 100 units sitting there in inventory. So we can apply the 1.35 to the 100 units and say, okay, so therefore my ending inventory cost is $135. That's what we've done. So our ending inventory is $135. That's what will go in the balance sheet at the end of the period. When the balance sheet, when you put all your current assets and you put inventory there, 135 will go there.
So Professor, in the last class that we had, right, it was, I forgot the name of it, but it was operations, okay, whatever. He said that there was a cost with inventory.
Yeah.
There's always a cost associated with inventory. This is the exact formula so that you know how much your cost is associated with inventory.
No, there are two costs associated with inventory. The cost of the ending inventory goes in the balance sheet, and the cost of the goods that were sold goes in the income statement.
So like warehouse for inventory, so you know.
No, that's got nothing to do, this has got nothing to do with that.
I just wanted to make sure.
Okay, all right. So now we have $135 in ending inventory. Now this formula comes of use. Because we know the left-hand side, we know that. That is the 200 plus all the purchases that you have done. So we know that the left-hand side is 1760. So simply subtract the 135, you know your cost of goods sold. Right? Because you know that the left-hand side cannot change, and just by the assumption of average cost, we determined what the ending inventory is, so your cost of goods sold simply becomes the left-hand side minus the ending inventory of 135, so that's your cost of goods sold. So on the income statement, when you report cost of goods sold, you will simply report 1760 minus 135 or 1625. That will become your cost of goods sold on the income statement to compute your profits. So you will take revenues, whatever the revenues are, minus the 1625, that will give you the first level profits, what we call as gross profits. And the gross profits would be based on the 1625 cost of goods sold. Right? So that is based on the weighted average. But again, remember, that's an assumption. It's an assumption saying that the goods that we sold those goods on an average, it cost us 135. Remember, the perfect system would have been to tag every item, and so when that item is sold, you know exactly how much that cost you. So this is assuming that we can do that. We cannot go the way of a car dealership where every item can be tagged. Okay. Here we cannot do that, so that's the reason why we kind of lump them together on an average cost basis and then use that average cost to determine what the ending inventory is and therefore what the cost of goods sold is. Okay? Okay. Now let's change the assumption. So now we are not going to do average cost. We are going to do the first one, the first in, first out, or the FIFO. The FIFO assumption says that everything that got bought first got sold first. So it followed that order. You bought it, stack it up. Okay, so then when you sell it, you take it from the bottom of the stack and sell it. So meaning that all the items that were bought first, they got sold first. So think about the stacking process. Okay, that might actually help understand. So you have stacked the goods, the old ones, then the new, and when you sell, you pull it from the bottom and sell it. So what is your ending inventory? Which stack does the ending inventory belong to? At the end of the period, what would be your ending inventory? Which stack? The newest stack. Perfect. The newest stack. Because that's at the top, that's not got pulled yet. You're stacking and you're pulling out of the bottom to sell. So what is still left is at the very top, which is the newest purchase. Since we know that we have 100 units in ending inventory, the FIFO assumption says the cost of this 100 units should be based on whatever you paid for the most recent purchase. And that was $1.50.
But you're losing money that way.
That's a different matter. So we are now going to assume that the items that are still left in inventory would be from the most recent purchases, and that is at $1.50.
So you don't apply the $1.35 to...
No more $1.35, because that assumption is for weighted average. We don't compute weighted average anymore.
Okay.
We just simply say that, okay, we have 100 units still left. It is all coming from the most recently purchased lot. So the cost of the 100 units for us is 100 times 1.5 or $150.
Okay.
Sorry, can we backtrack a little bit?
Yeah?
So we have, there's three assumptions: weighted average, first in, first out, last in, first out. Why are there three assumptions for this?
Now that's a good question. Because it makes logical sense. You think about it. So, while I did the weighted average first, think about it think about it this way. You either say that the earliest goods got sold first, or you say the most recent goods got sold first. Those are like two extreme assumptions. The weighted average is between the two.
Isn't that more exact, the weighted average?
The exact is a specific identification. That is the exact. Because you don't need assumptions at all. You have tagged it. You tagged it. And so every time you sell it, you know exactly how much you made. So you know the cost of goods sold.
So that depending how you run your inventory, you would use either first in, first out, last in, first out, so that's why it's the operation aspect.
Yes, that is an operational aspect of it, and in the same company, they could use both. Because in some countries, they can use one, and in the others, they can use both. So their inventory could be a mishmash of all the three assumptions.
Okay. Thank you.
Why is it difficult to just,
Why is it what?
why is it difficult to just tag items so you know?
It's expensive.
Think about it. If you're Walmart,
Because don't they have like barcode on items, like when you buy?
yeah, they
an
do,
item?
but then you have to track it to a purchase order. The barcode is there. You know exactly what item you have sold. So you can link it to a price so that the cashier knows exactly how much to charge you.
Right.
But think about the cost of that item to you. That would need linking of the barcode to a purchase order, and therefore going to the purchase order and picking up the cost.
You can
That's
do
going to be really difficult. That's going to be, Walmart does it. I'm not saying, I'm just picking Walmart to give you the complexity.
that. Right.
I'm just saying that it's very complex because of a store like Walmart with thousands of items being bought continuously, maybe at different prices. Maybe they don't have fixed prices for the whole period of time. So if it is bought at multiple prices, for you to go back to a purchase order every time an item is sold, it will take money. That's an investment that not all companies want to make.
So if you can tag, you can only use one of these? Or
No, you don't need it at all. That's my point. If you can tag, then you're back to the car dealership.
No, I said if you cannot tag.
If you cannot tag, then one of the three.
Okay.
Perfect, that's right. If you cannot tag, then you need one of the three.
Professor, could you scroll up a little bit? Or
Yeah.
minimize it?
How is it considered that?
Give me 1 second, let me answer that.
Yes, and then, does this information correlate with the date on
the
the
inventory
product?
video?
Yes.
The dates on the product, typically, because the earlier you bought it, the expiry date will show. I mean, if it is a perishable item like milk, or for that matter in pharmacies, when they have clear expiration dates. Yeah, it will typically coincide with the expiration dates. Yes.
I don't have an issue correlating the first in, first out. When I look at the inventory example, the first purchase that I did was in March.
No, your first purchase really is the beginning inventory. Remember that. So that is really the very first, because you got it from the previous period is already there.
So my first purchase, the reason why I say purchase because it says 3-1 purchase. Okay,
Yeah.
so the beginning inventory is my first purchase at $1. And thinking logically, first in, first out, my first purchase, it would be the $1. But you put the 150.
But it's first in, first out. The 150 is what is still not out,
Okay, that's all
right?
Then,
The 100 units are still not out.
then last in, first out. So
I guess you can order.
because I have to sell